We have been listening to remarks by President Biden on the labor market and other pending legislation before Congress, and we want to continue the discussion here. We're going to bring in Brian Jacobsen, Wells Fargo Asset Management, multi-asset strategist. And Brian, you were listening to the president just now saying that the employment rate shows that it's moving forward and that we are making consistent, steady progress in the labor market. Nevertheless, the headline payrolls number really disappointed this morning, coming in at 194,000 when the street was expecting 500,000. We got the labor force participation rate ticking down and also the unemployment rate ticking down to 4.8%. Kind of a surprise there, but people leaving the labor market. What do you make of the report this morning and President Biden's remarks on it?
Yeah, I think that the report this morning shows that really the details matter. And even though the report itself may have missed the expectation, maybe it just highlights that we don't know what to expect. To me and on my team, we think that the economic recovery is still taking place. It's on track. It's not like we should look at this as a disappointing number. 194,000 is a very strong number. If you look at the household survey from which they calculate the unemployment rate, it did show that the labor force participation rate ticked lower because people, for some reason, exited the labor force. But the employment number, so the new people employed, increased by more than 500,000. So we actually take a lot of encouragement when you look at some of the details that, this economic recovery and the labor market recovery, it's not like it's delayed. It's more like it's going to be drawn out. And it just might be drawn out over a longer period of time than what a lot of people were originally expecting. So instead of just like a big bang, a flood of workers coming into the market and getting employed in September, maybe that's going to play out over the course of months as opposed to a course of weeks.
And we also got the average hourly earnings statistic of 0.6%. So that's what it was last month. But the street was expecting that to be a little bit lower. Year over year, we're up to 4.6%. This has implications for inflation and also the calculus at the Fed. This is the last payrolls report that we're going to see before that, I believe, the November 2nd and 3rd meeting. So that's less than a month away right now. What is the Fed thinking as they look at this report and some of these wage numbers that we're talking about here?
Yeah, it makes me wonder whether the Fed thinks that maybe we should wait a week, so that we get another employment report under our belt. But this is set, a year in advance as far as the schedule. So they don't necessarily have that luxury, though you think they could look at the calendar. It's not like the Bureau of Labor Statistics keeps it secret as to when they're going to be releasing these things. But it also, I think, shows that the Fed isn't going to react to just one particular number, whether it's the payroll report number or the wage number. It's more, what's the trend? And the underlying trend is that we are seeing these rising wages, so the 4.6 year on year, but inflation is also quite high. So if you actually inflation adjust that 4.6%, people lost purchasing power on average year over year, because even though we don't get the September Consumer Price Index data until next week, based upon last week's, inflation was over 5.3%. So yes, wages rose, but not enough to make up for the pernicious effects of inflation. Now, some of that could be compositional, right? There was a big surprise about the leisure and hospitality industry increasing their employment. And we know that that's a bit on the lower end of the wage spectrum. So looking at these aggregate numbers, it kind of belies some of the important details, which is that wages are rising, especially for people who are employed and staying employed. The Atlanta Fed has a really nice wage tracker where it tracks that, where on a real purchasing power basis, people who are employed and continue to stay employed are experiencing real wage gains, but it doesn't look like it's necessarily, broadly speaking, causing any sort of wage price spiral that we have to really worry too much about.
Well, and just shifting gears a little bit, I want to talk to you about supply chain issues and especially the bottlenecks that we've been seeing that have really emerged this year and hampered so many different industries, especially the car industry. We know about the chip shortage. What's the progress on this in restoring some of these supply chains?
Very slow and unfortunately not just sluggish, but almost agonizingly so. Earlier in the year and even last year, the Federal Reserve and a lot of central bankers said that the course of the economic recovery will follow the course of COVID. right? That if you get the case counts under control, vaccination rates up, we should see an economic reopening. Well, as far as the economic recovery continuing and the inflationary pressures, that depends upon supply chains at this point. It's not necessarily any longer about COVID. It's more about the supply chains and how long does it take to get those unclogged. So get people back to work and get these supply chains unclogged. And that, unfortunately, it's just a matter of time. Some of the early indicators from the Federal Reserve's industrial production data shows that by stage of production, we are seeing some improvements. But again, it's going to be very slow and very gradual, but we're hoping that it can actually, just like the vaccination campaign, it starts slow, but it can maybe build some momentum as this year comes to a close.
Well, and we're seeing the 10-year T-note yield surge to a 4-month high here. That means bonds are selling off. And so if people are dumping bonds, what do you think they should be buying here?
Yeah, so the way we're positioning portfolios is to be a little bit more risk on. So with the equity exposure, with the higher yields, that does tend to favor more value-oriented names. So if you think about growth versus value, so imagine like financials, that's an area that we like, or energy, that's an area that we like with the higher energy prices that should accrue to the bottom line for a lot of these companies. So those are typically also known as the more cyclical areas. So growth stocks like technology, they tend to do really well when yields are falling and when growth is slowing. But if we have an environment where maybe growth can begin to accelerate again and yields can continue to rise, in our view, that really tilts things more in favor of value as opposed to growth.
And just kind of digging in a little bit further there, I've heard from a number of analysts, strategists, portfolio managers that it's really about the balance sheet and the strength of the balance sheet as interest rates rise, because companies have to fund their growth with debt. A lot of these companies do. And I think something like a quarter of the Russell 2000 stocks, they don't make enough money. They don't have enough profits to cover their interest payments. So if we're thinking about higher yields here and you like value, what do you think about the balance sheet argument?
I think that's a very valid argument. And in my mind, that actually just makes the argument for don't take a scattershot approach, be a lot more selective, probably work with a manager or analysts who are actively selecting the securities to focus on balance sheet strength. Early on in economic recovery, people don't care about quality. But as the rates rise and maybe those interest rates get to be a little bit more of a drag on the cash flows that are available for a business to distribute to shareholders, quality begins to matter once again. And so if rates do continue to rise, now we think that this big pop that we had isn't likely to continue. It's likely to slow a little. But if we end the year at, say, close to 2% on the 10-year Treasury, that can have a negative effect on poor, lower quality businesses on their cash flows that are available for shareholders. So we think that that quality argument is very valid, which is one of the reasons why we like working with more active pickers in this type of environment as opposed to just taking a passive approach.
Yeah, a stock picker's market. I've heard that various times over the last decade, and I really think it's about time for that. Brian Jacobsen, thank you for joining us here today from Wells Fargo Asset Management.